Good morning, happy Monday, and welcome to the Monday Market Update. My name is Nash Paradise, here for you as always, and joined, when I'm lucky, by the ultra handsome, super cool, and my good buddy Andrew Cady. How you doing this morning, Andrew?
Doing amazing. Had to update the background to be charts behind me. I can't. We got to have charts up today.
I like your charts. I recently changed my office around, and I lost my good streaming setup. I don't think anyone wants to get on here and see a bunch of pinball machines. It looks like an arcade over here. I'm like, this is not right. I gotta do something. Find a way to look cool. I got to green screen it like Andrew Cady does. But I'm just not that. I'm not Andrew Cady. There's a reason Andrew Cady's here, and it's because Andrew's Andrew. So, speaking of cool stuff, lots of charts and neat things to talk about, let's get into what happened last week. We had rated last week as a low volatility week, maybe low medium last week. And I think that held up pretty consistent, medium to medium high. Started the week at a 6.31 overnight average on the interest rates, dropped down to 6.27. As I'm looking through the weekly chart here, that doesn't really tell the story. We had a lot of intraday movement. Tuesday was kind of wild last week as we got ADP jobs came in low. Andrew and I talked about, hey, if ADP with this 10,000 job projection comes in short or high, like honestly, I thought it was set up to come in high. That could have been pretty gross. And instead, we came in low. Thoughts, Andrew, on the jobs report and information that came out last week?
I mean, it's just indicative that there's weakness in the labor market. We know this, like we've seen this, and it's just continuing to show its ugly face. What was surprising to me was we had a miss. It was a very low bar set. It was a very easy bar to beat to the upside, and we beat it negatively, impressively. And the markets didn't really react that much. I mean, you can see, okay, a 0.1% drop in rates when we show continued weakness, and it essentially teed up the Fed to do another rate cut. So I'm sitting here changing my tune a little bit. I do think after that report, we probably do see the December rate cut this week. But who knows with Powell at the helm?
Yeah, what the hell is a good way to summarize it, because even as you get to the end of last week, we look at Thursday and jumping into last week's data here. Greg, our producer, is filling in today. So I'm going to probably give Greg some cues here because Caden is out. So welcome, Greg, to the behind the scenes family. At the end of the week, looking at Thursday, we got initial jobless claims. And this is interesting because the headlines were way misleading. It was, lowest initial jobless claims in years. I was like, wait, what? We had been projecting 220,000 initial claims. We got 191,000. So there was a bit of a miss there. Previous was 216, revised to 218. It's not that far off. Being around 200,000, initial claims has been fairly consistent for a while now. Continued claims, these are people who have, been off the job for a significant amount of time, up to 1938. Projection was 1960. So we did miss slightly on the jobless claims, which seems to be contradictory to the ADP report, and took us into a confusing Friday where we had some big information, the September core PCE, all the good inflation data. And normally PCE, core PCE, like this is going to be big typically. No one cared on Friday. Everything came in flat. Core PCE was aligned. This is your what's PCE, Andrew? Because I can't say it for whatever
Personal
reason.
consumption expenditures. It's basically
Yeah.
the measure of inflation that measures what the consumer's paying.
Yep.
It's not like the producer price index, which is what the producers are paying. This is what this is what people are paying at the grocery store when you buy the new TV. This is the bottom line on it. And yeah, I
Hmm.
mean, it came in flat. It came in almost a little better than expectations. So you would have thought another run for the better. Markets are just as confused as everybody else right now.
Yeah, no one cared because it was September numbers, and for now and forever, I will not be able to say personal consumer expenditures. I can't. I don't know why. It doesn't roll off the tongue. But that was last week. Markets didn't care about the markets. Let's talk about what's going on here this week. So it may look like it ain't. It's Fed week. We know it's Fed week. We've been waiting for Fed week for a while. We got the Fed decision coming on Wednesday the 10th. But what I think is interesting is everyone is really cued in on the JOLTS data on Tuesday. JOLTS is going to be big. Where does it come in? I have no idea. I'm looking at, the job quits previous. We don't have anticipations on the quits. We do have on the openings a 7.2 million for September report. The previous was 7.22, so we're expecting things to come in pretty square here. No real change.
Yeah, and Nash,
Uh,
Nash, you're breaking up a little bit. Let me dive into JOLTS a little bit. For those of you
let's
that
go.
don't know JOLTS, what does JOLTS mean? JOLTS stands for job openings and labor turnover. This is a measurement of the strength of the labor market on a very clean face value. How many job openings are there? How much labor turnover is happening? How many people are being fired and people are being hired? Consensus is showing 7.2 million. This is going to be an all eyes on. And frankly, I think the impact meter on this being orange in the middle is probably a little off. I think this week, heading into the Fed rate decision, obviously that's going to be a big market mover. But heading into it, the JOLTS report is going to be huge. And what's a little concerning to me this morning is the 10-year treasury is on a run. And this is the opposite of what we've seen heading into Fed decisions previously. Previously, heading into the Fed decision, we see a big drop off in the 10-year treasury. And when the Fed makes the decision, we see the 10-year treasury jump back up. This morning, we're at almost 4.2 on the 10-year. We previously closed on Friday at 4.14. We're at 4.19 right now. So markets are not happy, and this is not on any big breaking news this morning. Are you seeing anything that's causing this run up in the 10-year this morning?
Bonds are under pressure right now. Start of a new week. Last week wasn't good on selling, and there's a lot of auctions going on this week. It's generally low liquidity at this time of year. So, bonds are getting hammered. It's bad, and not for any particular set of data. This is trading. This is the billion-dollar hedge funds moving things around. Treasury auctions are going to be interesting. I feel like JOLTS could completely counteract today's movement. But we'll just have to see. It is a big week, and we've gone up from medium volatility to high volatility in just a matter of hours so far this morning. So
It
we'll
is,
have to
and
see. Mhm.
what's also interesting is that the 10-year treasury is on a run this morning, but it's not impacting mortgage-backed securities a lot. Normally, the 10-year treasury and mortgage-backed securities never move in lockstep. We never see this like massive shift off on it. The 5.5 coupon as of right now is only off 4 basis points. Normally, if you're up 5 basis points on the 10-year treasury, you would expect to see 18 to 20, maybe 25 basis points worsening in mortgage-backed security pricing. Mortgage-backed securities are holding the line on some level this morning.
Bro, you need to refresh that screen.
No? Are they tearing off again?
Minus 28.
Oh, there we go.
5.0 coupon, though. So I'm tracking the 5.0. It seems to be the treasury or the MBS of choice lately. The 5.5 is more stable at the moment at negative 13. But yeah, as soon as we got over that, that ceiling of 415 on the treasury bond, the 10-year treasury, and then the mortgage bond started tearing off the other direction. So lots of volatile, high volume, high movement trading this morning. Not good for mortgage rates, but we'll see. There's a lot of things that can move the needle back. Greg, why don't you knock us out here to our next slide, and let's chat about what Andrew alluded to earlier, which was Nash has been saying we're getting a cut in December. Andrew has been saying, but wait, it's far from a foregone conclusion. Are we at a foregone conclusion now? We only got 2 days until the Fed meeting.
I mean, we still got a 10% chance based on investor sentiment that we're not getting one. I'm definitely leaning more towards getting one, but at the same time, I say that the Fed has been very, very carefully choreographing their moves, and I do believe they choreographed a hold. I believe that they openly choreographed that they're going to hold this meeting. I do think the data that's come out has been indicative enough for them to shift that previously set precedent of a hold to a cut. So I'm leaning cut. I think we see another 25 basis points, and then we move the hold into the January. But again, with Powell at the helm, it wouldn't surprise me if he just said, no, we're not doing a cut. Nothing surprises me with him.
Yeah, it could be interesting. We're obviously going to be more impacted, I think, by the minutes and by the notes, by the press conference after all this. Even getting the cut, typically the last few rate drops we've had, we've seen interest rates moving much better into that drop. This is the first time that we've actually gone backwards a good bit. The 10-year yield, right? Sorry, the Fed funds rate right now, 4.0. It's 25 bips better than it was last time, and yet we're higher on 10-year treasury, we're higher on MBS securities. This is not necessarily a recipe for success as far as we're concerned here in the real estate sector. So I do think we get the cut. I don't think we're going to see that sharp increase in rates like we did after the last couple cuts, because what's Powell going to say? Like, hey, the next cut's not forecasted until the end of April right now. So we've been
Correct.
broadcasting a cut and hold at some point, either December or January. But I believe we're getting that cut and hold now. And then it's going to be data taking over. Hopefully, we can slide back down the 10-year treasury yields from there.
And on one measure, I think there's something to be said about doing the cut in December and ripping the Band-Aid off, because that will remove a lot of questioning. If they do a hold in December, it's gonna leave the Band-Aid halfway on. Are they gonna do a cut in January, or is it gonna push out to the March one? I think if they do the cut in December, and then Powell makes no bones about it and says, listen, we've made enough cuts. We think it's time to enter a holding pattern. I think it removes a lot of the questions of what if, and we could actually see markets get better over it. So, I think getting the cut and then having the very clear language of don't expect another one at the next meeting would probably help markets. I think investors just want surety. I think it's this whole, hey, look at my left hand while my right hand does something else, is what's really spooking markets.
Yeah, and I think the interesting thing too, when we were looking forward here, is we're forecasting a cut in December, but then starting 2026, there are two cuts forecasted, one in April, one by about September, and then that's it through the end of 2026 and through all of 2027. There is no one right now thinking that we need to get to that 3.0% mark. That 3.25 seems to be the short and long term goal at this point. So only having two cuts to look forward to should mean a little bit more stability in our markets and what we see, figuring out where the 10-year treasury yield and things are going to go. It'd be great to get to a consistent mortgage market. We're complaining about interest rates here, and if you want to push us forward here, Greg, looking at the rate chart, I'm complaining about a 6.27 today. It's probably closer to 6.30 with today's increase. But I'm like, this is the rates that we were wishing for a year ago at this time. So I'm not real mad about a holding pattern here. I do think we could get to a holding pattern closer to that 6% mark. But what do you think eliminating, all but two rate cuts over the next 2 years means to where are mortgage rates going to settle?
I mean, I think we have to actually take some stock in what the economists from the Mortgage Bankers Association are saying. It's not the news we want to hear, but they're forecasting interest rates pretty much holding around that 6% through 2027. And it would line up with what the markets are predicting in Fed moves. Now, we also have to take into account, and I'm sure, listen, I'm not an economist. The guys that are the economists for the Mortgage Bankers Association are smarter than Nash and I put together times 10. However, I think there is a lot of other things besides Fed rate cuts that can move markets. And I think some of that is so unpredictable, you can't forecast for it. I mean, there could be global unsettlement. There we could enter a massive recession. There's so many things that could happen that we just don't know. But short of outside intervention, I think a nice 6% hold on mortgage rates is probably a very likely thing.
Yeah, I'd have to agree with you. I think we could slide down with some stability into the very low sixes, maybe even like the 5.95, 5.97 range as we're talking about throughout next year. And that aligns with a lot of those economist forecasts. I'm not an economist, I just play one on YouTube. And I think we can get into things like, G fees and LLPAs and some of the things that the government has control over, where they can push a button and literally lower interest rates and improve affordability. They're not apparently not going to do anything like that until it becomes a point that they have to act. There's no more room for the Fed right now. Our administration's putting a lot on the Fed's shoulders, but we're kind of towards the end of where the Fed's going. So it'll be interesting to look through 2026 and see what happens, see who steps up, who does what happens with European markets. Japan talking about starting to raise their interest rates. All these things affect everything that we do. And I think we're just going to have to be patient, watch the data, see what's going on. And, for a while, we're going to be gearing in pretty hard to reports. These new job reports, you got to remember, we just came out of a very long government shutdown. So starting to get good reports again, I say good, it's the BLS, not that good. Starting to get important reports again, we could see some higher volatility through the end of the year, which I think is interesting. And we'll be checking in here on a weekly basis to talk about that and help prep you for your week. Any other final thoughts there, Mr. Katie?
I got no other final thoughts. I appreciate you guys joining us today.
All right, homie. I hope everyone is excited for Fed Week. We'll get back together next week, talk about what Powell said. We'll both be watching the presser, so we'll have a pretty good idea of what's going on and what that means for us in the future. And I will be back next week. Mr. Katie will be out. We'll wish him well. I may try to talk someone else into coming here and chatting with me so you don't have to listen to me for 15 minutes straight. And we'll be back and checking in, let you know what's going on. And everyone have a fantastic Monday.
Take care, guys.